Ladies and gentlemen, thank you for standing by and welcome to the Sigma Healthcare full year results briefing. At this time, all participants are just in a listen-only mode. Following the presentation, there will be a question and answer session. To ask a question today, you will just need to press star 1 on your telephone. And just please be advised that today's conference is being recorded. But without further ado, I'll hand the conference over to your first speaker for today, CEO and Managing Director, Mark Hooper. Thank you, and please go ahead.
Thanks, and morning everyone, and welcome to the Sigma Healthcare results presentation for the year ending January 2021. Nice to be able to see people face to face again. Looking forward to catching up with investors over the next couple of days. With me today is Jackie Pearson, who was appointed our Group CFO in October last year. We've also got Gary Woodford, who is our Corporate Affairs Manager. While the last year's clearly had its challenges for everyone, the Sigma business has had a strong 12 months while continuing to build a more sustainable platform for growth. Sales have been strong across all our businesses and continue to grow well above market, and we'll talk about that in more detail later in the presentation. We've improved our cost base both through investment in new infrastructure as well as making changes to the way we operate. As we enter the FY22 year, we remain confident about further organic growth, and we're increasingly focused on business development opportunities to accelerate this. In terms of the format today, I'll start with some brief commentary around business performance over the last 12 months and our strategy moving forward. I'll then hand over to Jackie, who will take you through some of the financial results in more detail, as well as some commentary on other areas where she has some key accountabilities, including the ERP project. I'll then finish with some further detail around operational performance and business outlook. So I mentioned in my opening comments, the Sigma business has performed extremely well over FY21. We've seen a strong rebound in financial results with underlying EBITDA up nearly 40% to 81.1 million and a return on invested capital back above 10%. I think when we were talking to the market in September, we talked about hitting that 10% mark in about 12 to 18 months' time, so it's really pleasing to see getting back to that number earlier than what we expected. Importantly, all of this was achieved with no additional financial support during COVID-19, so we didn't have any rental relief, no JobKeeper support, so the result is purely off the back of Sigma trading performance. Sales performance was up strongly across all businesses, remembering the prior year actually had the Chemist Warehouse contract in total for the first 6 months, so when you look at it in that context, it's a really strong outcome. We've also continued on our transformation journey, including opening the last of our new DCs in Kemps Creek in New South Wales and Truganina in Victoria, and we're well progressed on the implementation of the S/4HANA ERP platform. Not sure what that product was I just described. It was a combination of a few things. When combined with the benefits of the gains that we've got through Project Pivot, the business is just in a much more efficient place to generate earnings growth into the future. Notwithstanding this ongoing investment, we also finished the year with a strong balance sheet, and I'm pleased to announce the board has reinstated the dividend, which is 1 cent fully franked for this period. And just as importantly, the board's announced a go-forward target of 70% of underlying NPAT as a target payout ratio. So this is not just a one-off, it's part of a program that we intend to have going into the future. Underpinning all of this was the continued focus on ESG issues, and pleasingly, in very challenging circumstances, both customer and team member engagement actually improved during the past 12 months. So I think that's a real testament to how the business has been run during that whole period, that both our customers and our team members feel like it's a great place to be. This is all completely consistent with our underlying strategy, where I guess the key drivers, which are shown in each of these boxes here, are to drive organic growth in the existing business, and as I mentioned, we've seen some clear evidence of that in the sales performance right throughout the business. Continuing to optimise our cost base, including taking advantage of the work done to date, but just as importantly, leveraging that into the future. And leveraging just the improvement in the general operating platform to look for further growth opportunities. As I mentioned in my earlier comments, we're also more aggressively looking at other business development activities. I think just in terms of some of the things we've had on and balance sheet capacity, that probably hasn't been as possible over the last couple of years. We're now in a great position to be able to accelerate that to further enhance shareholder returns. That's only possible if you've got an engaged team and you've got engaged customers, so that gives us a further advantage, I think, in today's market. As I'll talk about later, we continue to see further improvement in both of those measures, so again, a great platform to work with. So without any further ado, I'll hand you over to Jackie to walk you through the financial results.
Thanks, Mark. As already highlighted, FY21 has been a strong year for the Sigma business, delivering an increase of nearly 40% on underlying EBITDA compared to the prior year. This result was underpinned by a strong sales performance, with total sales up 4.8%. For our wholesale pharmacy business, sales, excluding Chemist Warehouse, were up 11.4%, which is a terrific result that is well up on the average market growth of around 3% and follows 8.5% growth for Sigma in the prior year. Pleasingly, this also includes a like-for-like wholesale sales increase of 9% across our retail brands, which is on the back of 11.7% growth in FY20. Offsetting these gains was Chemist Warehouse sales, which were 11.9% lower than last year, which did have the benefit of the full contract for the first 5 months. The result this year is in line with our expectations for the FMCG portfolio. Across our expansion businesses, we had strong medical consumable sales driven by increased demand for personal protective equipment during the height of the pandemic. Our hospitals business also performed well, recording sales increase of 15% following 26% growth last year. Offsetting this was reduced revenue in our MPS business due to the impacts of the pandemic within aged care facilities. Revenue from other parts of the business increased 11.1% on an underlying basis. This was primarily due to increased supplier rebates from large volume purchases, especially within the medical consumable space, and this also includes benefits flowing from the pivot initiatives. And it's worth also highlighting that the reported number includes gains from the disposal of assets during the year, including the gain from the sale and leaseback transaction. Our costs on an underlying basis are 4.5% above last year, but on a reported basis, we're 1.9% lower. This is impacted by the level of one-off costs each year to support our transformation efforts, with 18.4 million of one-off costs in FY21 compared to 35.4 million in FY20. Looking at each of the main categories, our reported warehouse and delivery expenses were 2.5% below last year. This was driven by efficiency improvements that we're realising from the investment in highly automated DCs, which has been offset by some reinvestment to support the return of the Chemist Warehouse FMCG business, which of course is then more than offset by the additional margin. There's also been an overall increase in the volume, including some significant spikes during the early stages of the pandemic, wage increases, and also some additional costs included to manage our response to the pandemic, such as increased cleaning costs. Our reported sales and marketing expenses were 3.6% below last year. This positive result is due to initiatives implemented as part of Project Pivot. However, for FY21, they've been partly offset by an additional doubtful debt provisioning, which we feel is appropriate given the general uncertainty in the economic environment as a result of the pandemic. If we exclude the doubtful debt provision, then sales and marketing costs were down by almost 10%, which is due to pivot cost efficiencies. Our reported administration expenses were 1.2% higher than last year, with the key driver for this variance being that in FY20 there was receipt of a large legal settlement. Excluding this amount, admin expenditure has decreased by 6.5%, which again is driven by pivot initiatives. Our depreciation and amortisation is 13.6% greater this year as we near completion of our capital investment cycle, and this also includes the impacts of the new leasing standard. And finally, we've seen a reduction in interest by 9.5%. This includes a reduction in debt interest following completion of the sale and leaseback transaction, which is then partly offset by the impacts of that new leasing standard. Looking ahead to FY22, we expect to see organic sales increasing, albeit there may continue to be some weakness in the OTC category. Chemist Warehouse FMCG business fully transitioned back to Sigma in June last year, so FY22 will benefit from a full year contribution of around 800 million in sales. In our expansion businesses, we expect to see some normalising of performance following the impacts of the pandemic last year. Whilst we don't expect to see the same level of PPE sales in FY22, this will be partly offset by an expected rebound in performance for the areas of the business that were negatively impacted by the pandemic in FY21. In other revenue, we will see a recovery in merchandise and marketing income, but we won't have the repeat of the gain recorded in FY21 for the sale and leaseback transaction. Our operating costs will continue to benefit from the actions taken as part of Pivot, as well as from the efficiency gains from the investment to create the best DC network in the industry. Offsetting this is an expected increase in IT costs associated with the implementation of our new SAP S/4HANA ERP system, although over time we expect to offset this with improvements from an operational perspective. Finally, we expect depreciation and amortisation to increase slightly, but debt interest should be below $5 million in FY22. As Mark highlighted in his opening comments, we're pleased to announce a 1 cent fully franked final dividend for FY21, with the key dates highlighted on the slide. With a strong earnings outlook and franking credits now available, we are targeting a dividend payout ratio of at least 70% of underlying NPAT. We retain the option of the share buyback, but we are not actively buying. Our preference is to use our capital to reward shareholders through fully franked dividends, whilst also retaining capacity to pursue strategic acquisitions that accelerate our growth. In terms of CapEx, we invested $77 million in FY21, primarily across our DC upgrade program and ERP project. In FY22, we expect CapEx to be around $55 million as we conclude these projects. Ongoing business as usual CapEx is then expected to be around $10 million from FY23 onwards. We continue to focus on our return on invested capital, which on the back of earnings growth has rebounded faster than we previously outlined. FY21 underlying ROIC was back to double digits at 10.1%, up from 7.1% at the same time last year, which was impacted by the business transformation and investment cycles. We expect underlying ROIC to now remain above 10%. We finished FY21 with a net debt position of $50.3 million, which is well down on the $146 million at the same time last year. This reduction is largely due to the positive impact of the proceeds from the sale and leaseback transaction. Looking ahead into FY22, we expect end-of-month debt to peak at around about $140 million in October of this year as we finalise the last of our major CapEx programs. With increasing free cash flow, we expect net debt to then reduce as we get closer to the end of FY22. In December 2020, we also finalised a $250 million debt facility with Westpac, providing certainty that our operational and CapEx requirements are covered for the next 3 years. Our cash conversion cycle increased by 5 days to 31 days at year end. This is primarily driven by an increased inventory holdings to support our growth, and we also increased certain inventory holdings in response to the pandemic. And there are also some timing impacts over the last 2 years due to the Chemist Warehouse exit and then the phased return of the FMCG portfolio and how that impacts this calculation. We expect the cash conversion cycle to return to the high 20s in FY22. Turning now to some of our transformation programs and starting with Project Pivot. With over $100 million in efficiency gains actioned by the end of FY21, Sigma has delivered on its original undertaking from 2019 to generate in excess of $100 million of operating efficiencies within a 2-year period. The actions taken to deliver the benefits occurred over 2 years, being the financial years 20 and 21. The benefits are then realised to the P&L over a 3-year period, being financial years 20, 21 and 22. As originally highlighted, approximately $60 million of the benefits related to the removal of the variable costs associated with the Chemist Warehouse contract. While this was achieved by late 2019, there has been some subsequent reinvestment of costs to support the return of the FMCG portfolio, which is obviously more than offset by the additional margin we earn. The remaining work streams within Project Pivot have improved Sigma's operational efficiencies by around $40 million on an ongoing basis. This benefit is reflected in a range of areas across the business, including lower costs, margin benefits and improved procurement outcomes. With the original target now achieved, Pivot has been formally closed and is now embedded as part of business as usual activities. Progressing our digital transformation has been another key area of focus for Sigma. This has included the implementation of Salesforce as our enterprise-wide customer relationship management application. We're also now over halfway through our SAP S/4HANA ERP implementation, which will go live in 2 releases during the last quarter of this year. Despite the challenges of the pandemic, our team has done an outstanding job to continue to deliver the project in line with expectations from both a schedule and budget perspective. In conjunction with the ERP project, we're also migrating all of our data, analytics and insights capabilities onto modern cloud, data cloud technologies, namely Microsoft Azure and Snowflake. And finally, we've also enhanced our strategy and practices in relation to cybersecurity. These digital transformation projects, combined with Project Pivot and the DC optimisation program, have created a resilient and efficient operating platform to enable sustainable growth. I'll now hand you back to Mark for some more details regarding our operational performance and business outlook.
Thanks, Jackie. So this is a few slides, as Jackie said, touching on in a bit more detail on a few key areas of our operations. First of all, I want to start and just dive a little bit more into the sales performance. Both Jackie and I have talked a fair bit about the absolute sales performance, but I think what you see on this slide in the top left-hand corner is, I think, some really telling comparisons to what's actually happening in the market. So you'll see there sales ex-Chem Warehouse. And the only reason we exclude Chem Warehouse is because when you've got them exiting and re-entering, right, it just muddies the numbers too much. But, you know, as we've both talked about, 11.4% up versus market growth of 3.1. So that's IQVIA data. So that's 8% above market, and that comes off the back of, I think, 8 or 9% growth in the prior year, right? So it's cycling strong growth on strong growth. So it's a really fantastic performance. Within that, ethical sales or prescription sales, for people who don't know what ethical means, we're up around 12% compared to market of about 5%. I think the most interesting piece of information on this slide for people is probably the OTC sales performance. We're up around 5%, but the market's actually gone backwards by about 3%. I mean, OTC has been a much tougher space to be in the last 12 months. That's primarily due to the performance of key categories like cough and cold. I mean, no one's been catching colds in the last 12 months. And whilst there's some offsets in things like, you know, sanitisers and things like that, overall OTC performance has been quite weak. I think Daigou activity within pharmacies also fallen away quite a bit now. That's not something that directly impacts us an enormous amount, but in the terms of the broader market, you've seen much weaker performance. So that OTC performance is probably less than what we would have expected, but you know, if you look at the comparison here, we're still 5 to 6% above market performance. So it's strong performance right throughout those categories. As Jackie mentioned, we onboarded Chem Warehouse back by June last year. You know, those, I think in truth, the sales, because March and April were a little higher because of COVID-19, they're probably back close to run rate a little earlier than that. But in terms of the formal full range returning, it didn't actually finish until June last year. In terms of pharmacy brand performance, and again, another strong performance here. So like-for-like sales within our brands are up by 9%. Again, cycling off the back of prior year strong performance at 11.7%. Now, I think the best of what else is happening in the market is sort of low single digits. So this is miles above what anyone else is doing. Pipeline of members is strong across the brands. And just to remind people, I mean, sometimes because we've got the sort of 5 or 6 different brands, people don't focus on the impact, but as a collective, we're sort of around that 17-18% of total consumer spend in pharmacy, so that's second only behind Chemist Warehouse, so it's a really significant footprint. And just a little more detail there on the voice of customer piece. So the Net Promoter Score improved by over 20% in the last 12 months, and I think I mentioned at the half year, we had some fabulous feedback during COVID-19. You know, I think that's where the new DCs that had the high degree of automation really came into their own. I think as an example, we just opened Kemps Creek when COVID hit, and that, you know, so that's a brand new DC, and it did 80% more volume than we'd done in the old DCs in the prior year and didn't miss a beat. So I think that's fed through to what's happened with in terms of customer performance. We're not pretending for a moment that we've got it perfect, but I think the fact that we now track this, and we have done for 2 or 3 years formally in terms of regular surveys across across a range of different activities we have with our customers means we're actively monitoring how we're going, and more critically, we're making the changes where we need to. One of the questions we always get when we do these roadshows is about what capacity we've got in the network and what efficiencies we're generating from the reinvestment program that we've been through. So what we've tried to include on this next slide is the expected productivity and unit cost benefits from FY20 to FY24. So it's effectively picking up 2 actual years and 3 forecast years to show you the ongoing benefit of the reinvestment in DCs. And the orange line on this chart is productivity, so there's a 30% improvement in productivity over the 5 years, and the blue or purple line, I'm not quite sure what it is unit costs. So they drop by 12% over that same period. Now, remember, you've got EBA increases going through, so that's 12% after absorbing those EBA increases. So it's a really significant advantage for the Sigma business, and as Jackie commented, it's just symptomatic of the fact that we feel like we've now got the most efficient DC network in the pharma space. I think the other point about the unit cost part is it confirms that original thesis that we had when we invested in these new DCs, that you get a payback of around 4 to 5 years on your automation. So that's absolutely being borne out in what we're seeing on an actual basis, despite the fact that when we did, I think, all of the DCs other than Truganina, we expected to have the full CW volume going through the shed. So the fact that we've lost part of that hasn't altered that underlying metric of around a 4 to 5 year payback. And just as critically, it's created capacity to absorb pharmacy wholesale volume growth. Now, we always get the question about how much capacity do you actually have. So as a general statement, I think we'd say we've got the ability to probably double the volume that we currently do through the network. There's a little bit of a qualification of that it needs to be sort of, existing business, right? Because you bring new business in and different stock ranges, then that impacts exactly what you can take on. But just like for like business, we could probably double the capacity right across the network if we had to. So that's a really significant advantage we have as well. Just turning to the expansion businesses that have also continued to show good growth over the last 12 months. CHS and MIA in particular saw additional sales from PPE that helped offset some of the other negative impacts from COVID-19. I think Jackie already touched on the fact that our MPS business, so dose administration services, had a slight decline in performance over the last 12 months because people just weren't going to aged care facilities, unfortunately, as one of the side impacts, and you can understand that with people being slightly reluctant to put aged relatives into that setting. So that impacted that business. But on the positive side, we saw good demand for PPE, so the CHS and MIA businesses benefited in particular. Not all of that's going to be sustainable moving forward, but I think the really important part from our point of view is that it's not going to go back to what it was in terms of demand for PPE, so it gives us a chance to rebase those businesses as ones that provide a much more substantial contribution to our earnings overall. Our 3PL and 4PL businesses continue to show good growth. I think, when we spoke to you last time, we were involved in a couple of big tenders, which we would have liked to have won. We unfortunately weren't successful in doing that, but we've continued to have a good flow of sort of small to medium-sized wins across the board, and I think, when I speak to our team that looks after that, they now feel like they've established themselves as a credible player in that space. So the reason that's important is people think about us when they have those sorts of opportunities coming up, and we're certainly participating in more of those processes over the last 6 months than we have previously. So again, we remain quite positive about the opportunities there. Likewise, hospitals continues to perform strongly. We've seen 15% growth again. There was some impact in that business, and I think we touched on it at the half year from deferral in elective surgeries. But again, because I think from a logistical perspective, the Sigma business performed really well during COVID, we picked up quite a bit of hospitals business that has stayed with us, that's contributed to that growth. So, that was a sort of a, $50, $60, $70 million business when we bought CHS 5 or 6 years ago. It's now north of 300 mil. We obviously have aspirations for it to be a much bigger business, but it continues to show good growth year on year. Just now, turning to some detail around COVID-19. I don't propose to go through everything on this slide, but it's worth highlighting some of the great work that's been done by the Sigma team just in supporting pharmacies, hospitals and aged care communities. I mean, All of our DCs were operating at full strength right throughout COVID. We didn't have any COVID issues within our DCs, which I think is testament to the sort of the plans we had in place and just how seriously people took it in terms of following those processes that we had in place. Like most other businesses, we had a cross-functional team that was set up so we could monitor what was a pretty rapidly changing set of circumstances. And I guess, as I noted in my opening comments, we didn't benefit from any additional government support or other financial assistance on the way through, so it's a clean set of numbers in that respect. We've always been quite proud about the work that we've done on ESG, and I guess we just wanted to touch on this in the presentation itself because we do have for the first time, a standalone sustainability report that we've released. We did include quite a bit of data in our annual report, but as most of you on this call would understand, this is becoming an increasing focus for the community generally, but also for investors. So we've decided to, pull that out as a separate document and give it a bit more focus, to more adequately capture the things we're already doing, but to provide a bit of a platform for this going forward. So again, this one is the famous evolving journey, but we think we've done some good stuff to date. And as I say, by pulling it out separately and providing that more specific focus, it just means we've got a better platform for progressing the work that we're doing here, and hopefully that feeds into some investor interest as well, which I think is hopefully one of the advantages that come out of it, as well as the benefits of the program itself. So just finishing off with a couple of slides to further expand on, I guess, why we have the confidence in where the business is right now and how we're going to deliver on the earnings that we've targeted over the next couple of years. While it has been an enormous amount of work right throughout the business over the last couple of years, we're now at the point where we've got a more sustainable business that's not only delivered very strong earnings for this year, it's well placed to continue to do that. The underlying operations platform's been upgraded. We've got brand new DCs. There's been an enormous investment in technology, which Jackie touched on in her presentation. There's another sort of 6 months to go to sort of round all of that out, right? But it is a complete replatforming of the business that lowers our costs, gives us the platform for growth, just puts us in a really strong position, and that's contributed a lot to this year, and it will help us moving forward. What that now does is it lets us leverage that opportunity, and as I've mentioned earlier, just looking for a bit of a sharper focus on business development and M&A going forward, so trying to further optimise what is possible out of the existing business, but also looking at M&A opportunities. And given that we've got the bulk of the transformation and spend out of the way and the balance sheet's now in good shape, I think we're, again, we get lots of questions about, what sort of acquisition could you fund? I don't think we've ever thought about it in that context. We think the business is in good shape. If the acquisition makes sense, we will get equity market and debt market support to do it. So we're not limiting what we're looking for in terms of scale. It's more about making sure that there's the right sort of strategic fit for the overall Sigma business. One of the other questions we get quite a lot is just providing a bit more granularity about how the earnings growth plays out over the next couple of years, because in truth we've been talking about getting to this $100 million earning target for a few years now. I guess we now approach that with much more certainty for no other reason than we're closer to the target. But this next slide is designed to just give you a bit more detail around how that's going to happen. At a general level, the forecast growth that we've got over the next 2 years is delivered through a combination of continued organic growth in the core business, further improvement in the cost base, both from our new DCs and the benefit of the ongoing benefit of the pivot program, and last but not least, the continued growth from our expansion businesses. So the exact mix of that varies from year to year, but they're the three things that are doing it. So the earnings growth that we've outlined to get to the $100 million by FY23 is really just the existing business based on existing performance levels, right? So we do think there's more opportunities to be able to sort of generate earnings growth from the core business above and beyond that, and then the M&A stuff's on top of that again, right? So this is just in essence a BAU target without trying to undersell the challenge of sometimes being able to manage that on a day-to-day basis. So there's a real opportunity here for us to generate some great returns from the core over the next couple of years for our shareholders, but equally we think there's a better opportunity to sort of leverage that further and to provide enhanced returns in the medium term. So just a few concluding comments on outlook. As I mentioned, we've talked about this 100 million for quite a while now. It implies just above 10% earnings growth for the next couple of years. I'm sure people have sat there and done the implied CAGR calc. It's around that 10 to 12%. We're very confident about being able to deliver that. Just as importantly, our return on invested capital is now back above 10%. I know people were, understandably concerned when that slipped back into single digits. But, we had invested quite a bit of money in sort of DCs, which inherently has a lease rate of return. So notwithstanding that, improved business performance has now driven that back above 10%, a little earlier than we would have anticipated. We've always thought about the Sigma business that provides growth at a reasonable yield. The reinstatement of the dividend now means we can tick the growth box and the yield box. And as both Jackie and I have touched on, the fact that we're targeting a minimum of 70% as an ongoing payout ratio means the expectation is there to be able to continue to do that. We've clearly got the earnings growth, we've got the cash, we should have the franking credits, so that all should be fine moving forward. We're always looking for ways to accelerate this moving forward. I feel like you should read these presentations a little sooner than you do, so I've made this point 100 times, but we are confident about the future and look forward to updating you on that journey as we move forward. So we'll throw it open for questions. We've got one from the audience here.
Thanks very much, Andrew Goodsall at MST. Just in a practical level, trying to understand your growth versus market. I mean, your numbers are extraordinarily high relative. I'm just trying to think through, is it that you've just got better exposure if people are shopping more local than perhaps, or just trying to get a few sort of dot points on what it is that's been driving?
I don't think it's changed since the last time we were sort of briefing the market. It's a combination of growth within our existing brands. So you see the like-for-like growth up quite strongly. So that's partly about people we've got in one of our brands using us for a higher percentage of the products that they buy, but also their underlying performance being better. And just I think the wholesale sales team's just done a really great job in terms of building a pipeline of opportunities. I mean, we haven't won any big groups in the last couple of years, so it's been a bit of a hard graft. But in one sense, we think that's more sustainable because it can't be unpicked by losing big groups. But the team's just done an outstanding job, quite frankly, in a more structured way than we used to do it. So I think the combination of that and the higher levels of growth from what we've already got is delivering that sort of number. I mean, we've done that. I reckon we've done that for 3 years now. So it's no accident what's happening now. That the challenge becomes your growth on growth on growth. But I think for the coming year, I think it would be ambitious to think we could do double digits again. I think we'd be quite confident about delivering above market again for the coming 12 months.
That's great, thank you. And just to get a sense on your hospital business as a percentage of the revenue, just get a sense of how big that is.
Look, it's around that sort of 3 to 350 mark, so that's around that 10% of total revenue. It's a lower margin business than pharmacy, right? So I've said before, you've got to look at it in that context. I think 3PL, 4PL and hospitals are best considered marginal businesses in terms of profitability, right? Because they do have lower returns, and they're the sort of business where you're building onto the fixed cost base you've already got to support retail pharmacy.
Thank you.
Another question from the floor?
Yep, thank you. Sorry, Rose McCummins, also from MST. Just going back to the into sales and the growth above industry average, who's losing?
Well, if you believe the market, no one is. It's a magic pudding, Rose. Everyone's growing at 10%.
Some things don't change.
Yeah, look, I don't know. It's a bit hard to work out. So, I mean, logically, if we're growing by that, it's partially off the other two big wholesalers. It's a bit hard to tell out of EBOS's numbers because obviously it's muddied a little bit by the Chem Warehouse business going back in.
Have you noticed a change in consumer? In that they want to go to the branded, they're looking in this sort of.
No, look, I don't.
No,
I don't.
Nothing.
I don't think there's anything noticeable from that perspective. Mm-hmm. I do think we've done a lot to straighten ourselves up in terms of our relationship with our branded pharmacies. That's improving the level of buying that we get. So that's part of the driver, and I think their performance has been better over the last couple of years as well, which is part of that like-for-like piece. But I think that's as much in that sense, we're more a B2B business than a B2C business from a Sigma perspective.
And in the new DCs, what's actually driving the increase in profit, the lower costs? What
Automation.
So it's staff.
Yeah,
it's staff.
so it's... Yeah, I mean, it's just a much lower level of staffing that's required when you've got that level of automation. I mean, it's quite literally the sort of automation that's gone into the new big DCs is goods to person. So someone stands there and the product comes to them rather than having to wander around and get the product. It's as simple as that.
More accurate in terms of picking and things like
Yep.
that?
So lower errors. Yep. So, and it's better in terms of, your stock dating because it's, and particularly when we get to ERP, right? We'll have the benefits of that as well. So, I mean, and it's just future-proof from a compliance perspective. It's just, there's advantages right across the board. Yep.
Okay, thank you.
But the issue is you've got to be prepared to spend the capital up front, which is where most people balk at it, right? And I think we were always quite confident that we would get the return from the automation, but when we lost Chem Warehouse, that obviously punched a fair hole in the volume, and we thought maybe it might slip from sort of 4 to 5 years out to sort of 7 to 8 years. But the experience, particularly getting the FMCG volume back, is it'll be around that 4 to 5 year mark. So if you think about the $300 million that we've spent on new DCs, in very broad terms, about 2/3 of that's been on land and buildings. We got most of that back when we did the sale and lease back, and we sold off the other surplus land. So net from a cash flow perspective, we're square there. And on the automation piece, we'll get a payback over 4 to 5 years. So after a 4 to 5 year period, you've effectively completely funded a new DC network. So it's a great outcome, but I guess you've got to be brave enough to make the investment call up front.
Go to calls online.
Okay, thank you. For the ladies and gentlemen on the phones, once again, it's just by pressing star 1 to ask a question. But our first question comes from Philip from Blue Ocean Equities. Please ask your question, Philip.
Hi guys. Firstly, well done on a good result in some pretty tough conditions. Obviously, the strong like-for-likes have been commented on, but just curious to see which categories have done well, because we're all stuck at home, so nobody got sick, so cold and flu would have been down. And as you pointed out, Dago was down. So was there a particular category that was strong, and did the CSO 7 have a material impact once that kicked in?
Look, I don't know, like in terms of individual categories, there's anything that sort of stands out. I mean, prescription drug performance obviously stronger than OTC, I think is the best way to think about that, right? It was your market growth for ethical products is sort of 5 to 6 versus OTC going backwards by 3. So I think in that sense that was the standout within the pharmacy environment. The 7th CPA sort of impacted the second half, so it would have given us a slight positive impact, but nothing material in this set of results. Jackie, you've got any view on that?
Nothing material.
Yeah. So look, no, I don't. Yeah, look, within OTC, Phil, as I said earlier, I think, export categories were probably down because Daigou buying was down, cough and cold was down. There's been patches of where beauty's been down and then it's bounced again when everyone wants to look beautiful going out. It depends which month you're looking at. Or the for Zoom calls. I was surprised when I saw the market data on OTC, to be honest. I had assumed it was broadly probably flat or low growth, but when, we've seen some pretty consistent IQVIA data now that says it's been down on last year for quite a while now. So you'll be cycling through a bit of that. So it'll be interesting to see what plays out over the next few months. But I think we're assuming sort of flat to low growth will return sometime in the second half, but we're not assuming a sort of a massive rebound in OTC as part of our outlook.
Sure. And I guess the second question is, sorry, it's going to say that. Your view on the vaccine going forward, the role the pharmacists are likely to play, and whether that's positive on selling other products while people are in there?
Yeah, I mean, pharmacy has to be involved in the rollout of the vaccines, right? I mean, you can't pump 50 million vaccines into people and ask doctors all to do it. You can see the stress they're already under doing the Pfizer piece, right? So pharmacy has established themselves as a credible and safe provider of the flu vaccine. It's a very logical role for them to play in the rollout of the AstraZeneca or AstraZeneca type vaccines, where you don't have the temperature requirements, basically. And, whilst we're not directly involved in the rollout of that, we obviously would have liked to have been, but the government's made the decision to award that to DHL and Linfox. I think overall it's probably going to have a positive impact on pharmacy trading just because you're going to have foot traffic going through. Now, whether that's material enough to make a difference, I don't know, but it certainly doesn't hurt to have a reason for people to be able to go to pharmacy to improve the opportunity for extra sales within that environment.
Excellent. Thank you.
Okay, we have another question from the phones. I'll go to Gretel Garnu from Credit Suisse. Please ask your question, Gretel.
Thanks very much. Hi, guys. Just firstly on the sales slide, clearly the last 12 months wasn't a normal year. So just in terms of market growth expectations in the next 12 months for each of the different categories, I know you just mentioned OTC before, but for ethical and then on the retail side as well, that'd be helpful.
Yeah, I think we're thinking about ethical probably going around sort of 3 to 4%, and I think OTC when we started the year probably modest growth around that sort of 1 to 2, but it might be a bit flatter than that overall. I mean, as you saw from our numbers, we've been actually able to grow sort of 5 to 6% above market. So I mean, we would hope to be able to continue to do that, but yeah, the OTC market probably, as a general statement, probably flat for the whole year, I would think.
Okay, great. That's very helpful. And then just in terms of cash performance, a little weak in this period. I guess how confident are you that it will turn around and improve in the next 12 months?
Oh, don't forget the big part of that year to year is the fact that with Chemist Warehouse exited, but I'll hand you over to Jackie for that one.
Yeah, look, I think we are quite confident that we'll be able to return that cash conversion cycle back to the high 20s. I think in terms of the result that you've seen for FY21, there has been quite an investment in stock, and as Mark has indicated, there's also the anomaly of Chemist Warehouse exiting in the prior year and phased return back in FY21 as well. I think we'll continue to have quite a focus, though, in terms of our inventory holdings and I guess have quite a heavy focus in terms of making sure that we're meeting the needs of our customer base. And that has included holding some additional inventory for some of our specific customers who have effectively reserved that inventory in order to make sure that there's no supply impacts whilst we continue to obviously work our way through the pandemic. So expect to see the improvement, albeit there may be some additional inventory builds throughout the year as we progress the last of our two big transformation programs. Namely, as we go live from an ERP perspective and as we continue to finalise the last of the DC optimisation program.
I mean, the inventory point's an interesting one, Gretel. I mean, when the panic started, trying to guess what stock you should be holding was almost impossible, right? I mean, I can remember right at the start of COVID-19 thinking, should I be out there buying face masks? And the problem is you could load up on something and then not be sure that you could sell it. But I think as the year's gone on, because we've had strong sales growth, our inclination has been to hold more stock than less, right? If there's a spike in demand, you just can't get it quickly enough. So for core lines that turn quickly, we've just chosen to hold a bit more stock than we would normally. And we've got a few arrangements. I mean, Jackie just sort of partially referred to one where we've had a few hospitals that have pre-purchased stock that so they've paid us for the stock, but we're holding it, right? So that they've got certainty of being able to get access. So there's a raft of things that are contributing to a higher stock holding that you see reflected in the numbers at the moment. But we think from a business perspective are the right things to do in the current environment. Now, if things normalise, that'll just naturally run down over time. So I don't think the original guidance we gave last time we spoke, which is sort of something in the mid to high 20s of the cash conversion cycle, is something that we don't think we'll get back to. But I think right at the moment, we're comfortable holding a bit more stock. And as I say, you've got a couple of anomalies in there where people have actually prepaid for stock that we're holding that we're still showing as part of that.
Understood, thanks. And then final question, just on the digital transformation and particularly the ERP program, like how much of an earnings benefit will this bring, and is that already factored into that 100 million EBITDA target that you do have?
So in terms of the ERP implementation, we haven't factored in any substantial efficiency gains as a result of that implementation. There's a small consideration in terms of our cash conversion cycle. It will actually help in terms of some of the processes that sit behind that. But outside of that, there hasn't been additional benefits factored into that 100 mil target going forward. The program itself is expected to go live in the last quarter of this year. It goes live across 2 releases, being our Sigma business first, followed by our subsidiary businesses. And we'll spend time next year then, once we've matured the system and worked with it, we will then spend some time having a look at where there's some upside opportunity in terms of our outlook, where we do expect to be able to achieve some efficiency gains, and particularly to offset some of the additional costs that come from running a big state-of-the-art ERP like the SAP S/4HANA implementation that we're putting in.
So I think, Gretel, there, I mean, clearly we expect to get some efficiency benefits of a new ERP program, but rather than trying to guess some bullshit numbers to pop into the guidance, it's a technical term, we've taken the view, we know there should be a return from that. We have included the additional costs that come with running a platform like S/4HANA within the guidance, but we haven't factored in the operational efficiencies that we think we should get out of that. And I guess as Jackie's alluding to, when we get to the point where we've got this thing implemented, we can then have a more meaningful go at trying to extract those efficiencies across the business. Because quite frankly, trying to do that before we've installed the thing, no one's going to take it seriously. We need to get it in properly, understand what it's done to the business, and then look for the opportunities. But that's all on top of any guidance we've given here.
Understood. Thank you very much.
Your next question comes from Ross Curran from Macquarie. Please ask your question, Ross.
Hi, team. I've got 2 quick questions, if you wouldn't mind, probably both for Jackie. Firstly, just on the provision for bad debts, I was just wondering, if I look at the trade receivables, 30, 60 and 68 plus, they're all down 21 and 20. So just can you talk us through why you've increased your trade receivable bad debt provision this year in light of improving performance on trade receivables?
Yeah, sure. In the first half, it probably more related to some specific arrangements that we put in place for some customers that were quite significantly impacted by the pandemic. So some customers in locations within airports and CBD locations, etc., that were really quite significantly impacted. In the second half, we haven't actually had any issues in terms of those isolations, so a lot of that provision's actually now been written back. In the second half, it's more, I guess, within the general provision and more reflective of the general economic outlook. We think it's appropriate, given that JobKeeper and the like is about to come off, that we do increase our credit loss rating across our general provision. So it's not specific to any particular bad debts that we're watching. In particular, it's more a general, sort of appropriate approach to take given the economic environment that we're in at the moment.
I just flag because it quite in contrast to what the banks are doing, where they're actually writing back provisions. Is there potentially an opportunity to see that provision get unwound over the coming financial year?
Look, ultimately we would like to see it unwound over the coming year if we continue to see no issues in terms of the credit activities within the organisation. So at this point in time, we think it's appropriate because we haven't seen the impacts of the unwinding of things like JobKeeper, and we want to obviously make sure that we're appropriately provisioning for small businesses in that particular set of circumstances. But we'll obviously continue to monitor that and assess whether or not there does need to be any adjustment to that credit loss rating that we have applied at this particular point in time.
I think, Ross, we would quite happily accept that's a conservative position, right? I mean, we haven't actually had any losses from COVID-19, touch wood, right? But, I think when, as Jackie says, when JobKeeper ends, there will be some impacts that flow through. So effectively flipping that into a general provision feels like the right thing to do at the moment. Hopefully we don't need any of it, and as you say, maybe there's an opportunity to return that later. But in the current environment, we didn't need to be overly aggressive, and we feel like it's appropriate to have that general provision sitting there.
Sure. I won't mention holologging if you don't. And then the second point is just around the the extra payments for PPE sales in the current financial year. Can you talk us through, is that a high watermark? Do you need to beat your FY21 level of sales to be eligible for rebates this year? Or is it just sort of a general volume target that you could potentially get again over the coming year?
I'm not quite sure I understand the question, but if it's around the level of PPE sales, the level of PPE sales won't be as high this year. I mean, I think I made the comment during the presentation, there was clearly some one-off level of PPE sales that we saw in the current year that won't repeat. But equally, we think we can rebase I guess, for the want of a better description, the core level of sales that comes from that business will be higher than what it has historically been, because we think the level of demand for PPE is permanently shifted upwards, and we have quite consciously invested in people resources and other resources to support that business over the past 6 to 9 months to try and take advantage of that. But I don't expect it's going to be at the same level we saw in FY21, but I guess offsetting that, there'll be improved performance out of other businesses that were knocked around from COVID, like the MPS business, that will help offset that. But, I mean, as an overall statement, we're still actually quite positive about what we can do with that sort of medcons part of the business, right? We think that's a real opportunity for it to be a meaningful contributor to overall earnings. And the events of the last 12 months have given us the platform to sort of expand what we've been doing in that space.
I guess my point is, can you still be eligible for large volume purchase rebates from the suppliers if the volume is below the last 12 months?
Yeah, we do believe we can be. However, it'll be on different product mix. So where we've had some, I guess, decline in terms of volume rebates over the last 12 months that have been more impacted by those categories that Mark's talked about from a pandemic perspective, we would see a rebound in terms of performance in those areas that will offset the expected reduction in the PPE sales piece.
Thank you.
Okay, we have another question on the lines from David Stanton from Jefferies. Please ask your question, David.
Morning, everyone, and thanks for taking my questions. Look, firstly, could you give us broad brush a clue as to your capacity utilization in your DCs now in F21, and what basically how much more volume could you push through should you win contracts or the like?
So I think I made the comment in the presentation, Dave. We think we've basically double the volume that we currently have going through the DCs today, based on the capacity that we've got. But I guess the qualifier to that, it would be sort of twice as much of the same product, right? So this is given our core business is pharmacy distribution of products to pharmacy, so it would be around those sorts of stock ranges. If it was 3PL, 4PL work, we've still probably got capacity there, and we could comfortably expand that if we needed to, because some of it's not temperature sensitive, so we would just take out new DC space if we needed to support that. But as a general statement on pharmacy ranges, we could double what we could do at the moment.
Thank you. I missed that. Sorry. And we used to hear about compliance rates within your pharmacies and how you were improving those. Can you sort of comment as to what your compliance rates now are in terms of the pharmacies that your grandfather or other pharmacies, and how that's contributed to the very good wholesale sales growth?
Yeah, look, I probably wouldn't want to give specific data on compliance levels, but they have improved on a pretty consistent basis over the past 2 or 3 years. And to your point, that's absolutely part of what's contributed to the sales performance, right? I mean, the improvement in like-for-like growth within the brands, has in part been just, our branded stores are buying more from us, which is part of the value proposition we put to branded pharmacies, right? If we're going to spend the money investing in providing retail and marketing services for you, our expectation is you buy most of your product from us, right? There's no point in having a branded store that doesn't buy any product from you. You don't make any money out of that. So, that's part of the partnership. So that's been improving, pretty consistently over the past 2 or 3 years. It's one of those key metrics that we monitor on a monthly basis. So that's been a key driver of some of that like-for-like performance in particular.
Understood. Thanks. And then just a general statement on terms of trade for wholesalers across the industry. Are we seeing any major changes one way or the other?
Oh, look, it's always been a pretty aggressive market, Dave. I don't think in my 15 years in this industry has been anything else but aggressive. I think from a Sigma perspective, I think we've got our payment days in really good shape. We don't have any really extended credit out there, which would be different, I think, to the broader market. That seems to be more widely on offer from other wholesalers. And on actual trading terms, I mean, that's just always competitive. As you know, we are economically rational beasts at Sigma, so unless we're making a return, we don't do the business. But that sometimes makes it hard to win new business, but no point in winning business you make no money of. So we've been able to continue to grow the business while meeting that objective. So I don't see any reason why that's not going to continue, but it's a competitive market.
Understood. And final question, perhaps one for Jackie. Firstly, Jackie, thanks for the sort of colour around 22 growth. Just had a question around tax rate for 22. Should we be thinking, effective tax rate for 22 in line with 21, please?
Yeah, it should be roughly in line with 21 if you back out the tax credit. So I think the effective rate was about 27.7% in FY21. So we should see a reasonably steady continuation of around that rate.
Thank you very much.
There's a few things in the result, Dave, that get mucked up by the gain on the sale and lease back. I mean, whilst nominally it was 80, so we paid about $90 million for that land and building and sold it for 170. The way the new wacky accounting standard works, we only recognise 30 of it now, and then the rest gets deferred over time. And then we didn't pay tax on it, so that flows through the tax calc. So it's all a bit hard to follow.
Carry-forward losses used. Yep.
So I mean, we've always been sort of around a 30% effective tax rate. We get a little bit of R&D on the way through, so it's around that 29, 30, 31 is how you should think about it.
Understood. Thanks very much.
Okay, and we have a final question from Matthew Chevrier from Citi. Please ask your question, Matthew.
Good morning, and thank you for taking my question. I just had a simple one, which might actually be difficult to answer, is could you quantify the net COVID impact at, I guess, the EBITDA or EBIT line?
So we haven't put that data out publicly. It's a slight positive overall. So, there's obviously a few sensitivities in sort of going into any detail on that. We had said overall it's a slight positive for the business. I mean, the real positive out of what we saw last year was on the PPE sales. I think the negatives were, despite the fact that we had very strong wholesale sales, things like airport pharmacies and city locations were impacted. So we think it would have even potentially been slightly stronger, both in pharmacy and hospitals. MPS was obviously knocked around. Our merchant marketing income was knocked around because I think for that sort of period from sort of February, March through to about June, there wasn't many promotions happening because no one needed to do that. So we've had some one-off costs in the business with cleaning and other bits and pieces. But net, we're a slight beneficiary overall. And I guess that's why the fact, I guess I think the more critical thing then is the outlook, right? Because if we'd had such a benefit out of COVID, that was non-repeating, then you wouldn't be able to sort of talk confidently about the growth moving forward. So the fact that it was a slight positive and we're still talking about growth of sort of slightly in excess of 10% for the next couple of years without any of that impact feeding through is the sort of more important point.
Yeah, understood. And just on that growth, would it be fair to expect that the growth in 23 would be higher than the growth that you would expect in 22?
No, look, it's reasonably even across the 2 years. So I mean, I haven't got the numbers here with me, but from recollection, I'm just sort of looking at Jackie in case I've got this wrong. But it's reasonably even across a couple of years. I mean, as I said a number of times through the presentation, our ambition would be to sort of beat that through organic and growth and M&A type activities, right? But in terms of the business we have in front of us today, with a sort of just steady as she goes approach. That's the sort of number we think we'll deliver over the next couple of years. So it's, you've got a good growth platform, you've got a good dividend yield, you've got a strong balance sheet to be able to fund things. So, the opportunity that sits in front of the business is to take advantage of that off the back of, quite frankly, 2 to 3 years of really hard work.
Yeah, understood. And just on the outlook, and you signed the Chemist Warehouse contract before the pandemic. Obviously, has the pandemic changed the outlook and the growth you expect from Chem Warehouse? Obviously, given their reliance on Dagos and I guess international tourism.
No, it hasn't changed our outlook. They've continued to trade very strongly throughout the pandemic, albeit they did have a couple of locations, mainly in heavy into CBD locations that were a little bit more impacted. But outside of that, they continue to trade very strongly, and so therefore we remain confident in terms of the forecast that we have against that particular group.
I mean, they do have a big export business, right? But they tend to take that product direct. That doesn't come through us. Yeah, understood. And just on the expansion businesses, could you give us an idea of what kind of revenue and EBITDA they generate at this stage? Talking about the hospital and the 3PL, 4PL businesses. So, I mean, it's better to focus that in terms of contribution to EBITDA than revenue, right? Because they're different margin businesses. So look, I think in broad terms at the moment, we'd probably be looking for sort of around a quarter of our earnings to come from those expansion businesses, and obviously we're looking for that to grow over time.
That's great, thank you. And just one final one on interest and D&A. So you said interest on debt would be around 5 million. Does that include the leases interest, or I guess payment?
Sorry, I just missed that. The leasing? No, that doesn't include the impacts from the lease standard.
Okay, so how much would it be including the leases, roughly?
It'll be reasonably consistent with this year. It'll be around about 10 with the lease standard incorporated in that number.
Excellent. And then on the D&A, that'll be, you said, comparable year on year in 22?
It'll be just a slight increase this year, and that's primarily due to the sale and leaseback transaction. So the lease standard impact in terms of Kemps Creek and Berrinba, and also with the Kemps Creek DC becoming operational partway through last year.
That's great. Thanks very much.
Okay, there are no further questions at this time, so I'll hand the conference back to your presenters for any closing remarks.
Thanks everyone for your time. I look forward to catching up with people face to face over the next couple of days. Thanks again.